morning. Hope it, hope it's a good morning for you. I got stuff dinging around here. Let me shut off something I forgot to shut off on my computer. Okay, let me see. What is today? Today's Thursday, so I hope you're looking forward to a good weekend. Beautiful weather, typical October in Southwest Virginia, just gorgeous. And here you are stuck in construction economy. Sorry about that. If we could, if only 20, the 20 of you and me could be meeting in some nice, relaxed atmosphere, drinking whatever beverage you drink in the morning, preferably non-alcoholic, and enjoying the beautiful weather outside. Some of you might be outside. I should be outside. That would be wonderful. I gotta move my chair a little bit. So anyway, happy Thursday. I don't have much to announce. Grades. I haven't looked this morning to see if Mitch presented a surprise. Unbeknownst to me, which he doesn't do. Anyway, so the grades are coming on the midterm. There was a couple of issues that we had to address, but I think we've got those all done up. So be looking for it after class, not immediately after class, but be looking for that in the next coming hours and days. You will also notice the assignment that was posted as promised, very, very close to the end of class on Tuesday. And that's the 3-week assignment. It's not due till November something, 12th or some other similar number. And that's just doing a bunch of ratios on your own. Find a company. So you have to go out, you have to find a company, and it's described. I'm not going to go through it. If you have questions, let me know, but it's reasonably well described, I think. So don't forget that. There's also, there'll be a homework assignment that gets posted today, and that will be due next week. And this homework assignment is going to be, like a regular homework assignment, regular points and everything. But it's going to be this material we're covering today, and it's again, some of you have had some accounting, and so this is nothing. This is old hat. This is ho hum. For those who have not had it, this can seem overwhelming. I have some tips for you in that regard as we move through the day. So hopefully that'll work out. Today we are in chapter 3 mostly, chapter 4 just a little bit. Chapter 4 is maybe 4 or 5 pages in the textbook, and there's some things in there that I want to highlight, but it's not a long drawn out, conceptually difficult material. And then next Tuesday we will slide into chapter 5. So we're moving a pace here, and chapter 5 will get us depreciation. We'll talk a little bit about depreciation today, not in terms of determining what it is, but that's another accounting concept that's very important. And a friend of mine used to work at Westmoreland Coal Company, and I'm not even sure that still exists. But he said most of their financial decisions were driven by depreciation, and that's an interesting concept. And of course, they're very equipment heavy. We're going to be talking about entries accounting entries, financial entries into the books of account today. So I'm gonna pop up a little pick up where we were in the PowerPoint briefly, and I want to talk about some of these concepts we're going to talk about, and then I've got a little in-class work for you to do. So we'll do one of those. We're going to take a 15 or a 20-minute break, not a break, a working break. For you, for me, I think I'll take a 20-minute nap. And while you're working on this assignment, then we'll come back and we'll talk through the solutions, the answers. This is not a graded assignment. This is simply I think you'll benefit by maybe struggling through this assignment that won't count against you when you get it wrong, but will be helpful. I'll talk a little bit more about that philosophy with this kind of material here in just a little bit. Okay, maybe enough said. Let's, as I continue to admit folks here, I'm kind of distracted with that. So let me see where we left off last time. And you'll notice here we were looking at the ledgers. And let me go back a slide. We looked at the job cost ledger, and you can see it. You can see it there. And we have. You can see how the code structure of this works. We have a job number, and then maybe this is optional if you put a phase in there or not. And then we have the particular cost code for what it is. And then we have all the different elements that can be, and typically that's a cost type, and that comes in at the very end. Again, as I mentioned on Tuesday, the way this works, the way this is set up in the textbook is certainly workable and common and used a lot. It's not required that you use this particular job cost structure. You might have codes that tell you all, you may have some very, very specific elements that you need to include in there that most construction companies would not. So you have a different structure that meets the needs of your company. That's fine. That's since we're not a particular company, we're going to consider that what the text uses is fine. You don't have to memorize any of these numbers or codes. Gee, what is the, remember cash is the 100s. And gosh, what's 200? I can't remember. Don't worry about that. That's nothing that you need to memorize. And if you use this particular structure, let's say, in your business, you would very quickly know those numbers because you'd be using them all the time. And you'd be, this is a 200 account or this is a 500 account. You'd know exactly where those go in very quick order. I had experience with that just a little bit. At the university has its own cost structure, job structure, and the different codes that they use. And when you come into a university, you learn what those codes are. 201, 203, the overhead account codes, you learn those just pretty soon, they're etched in your brain. So anyway, we had the job cost ledger. We discussed that a little bit. And then we had we talked about the equipment ledger and how this breaks down different charges, costs that are applied to the various equipment that you have in the company. So we stopped there as I recall, best as I recall. We stopped there on Tuesday, and then we move into this. Today is detail. It's very fine detail, and it's things that you need to be familiar with. You don't need to be an expert on. You will have an expert, and it will be your accountant. Now, some of you will begin by kind of serving as your own accountant, and if you start a really small business, before you hire somebody maybe to handle your books, and even if you do hire somebody to handle your books, you want to know what's going on. You need to have a handle on these things, because as I said way back first of class, if you don't manage your finances properly, you will soon be out of business. And you can't manage if you don't have visibility, if you don't have a knowledge of what's happening in your organization. So anyway, you need to know these things at some level of detail. Okay, so let's kind of dive into that detail. Now, what I want to do briefly, and I hope this works. I have my my other camera ready to go here, and I want to talk about debits and credits, and because this, to me, this is one of the things that makes introductory level type accounting such a challenge, is just a little bit about knowing and understanding what a debit is and what a credit is and why it's treated this way. And so let's see if this other camera works. Well, it's not too bad. It'll freeze, I'm sure, as it always does. But so far, so good. It's working okay. So let's just for a minute talk about these elements. And I decided to do it this way because I want to throw these things up and talk about them a little bit, as opposed to just slamming them all up there on the slide, which is the next slide in the set, has this information in there. But I think it's, I don't know, I thought it might be helpful just to draw it out here. If we think about an income statement, and you know, we hear these terms debits and credits. And a debit, if you have a debit on your income statement, the revenue goes down. Now, what does that mean? You know, when I think of debit, I don't know, the word debt comes to mind, and that's not what that word means. So try to throw that out of your mind. Debit is like, I spent money. I really did spend it. And credit is like when you get money. So a credit on the revenue side of the income statement there, if I can use that terminology, a credit increases your revenue. A credit is like you get money, right? Someone credits your account. Well, that means that your money was put into that account. On the flip side, remember, our profits are revenue minus expense. And on the flip side, you spend money, that's an expense. So a debit, spending money, if you will, that's the way I think about it. That works for me. the expense is increased, and a credit, therefore, would be a decrease in expense. I don't know if the way that I think about it, I'm not sure that's a uniform way to think about it, and so it may not work for you. And if it doesn't, and you've got something else to help, that's fine. Don't worry about it. Okay, now on the balance sheet side of things, if we're looking at the assets, then an increase in our assets is a debit will increase our assets. Let me say it that way. It's like I don't know, the way I think about it. It's like I spent money and I got something. That's that's a pretty lame way to think about it, but it's my way. So so I think about it that way. A credit will decrease your assets, and now we can flip those when we're talking about liabilities, of course, since liabilities are kind of like the opposite of assets. Then increase in liability is a credit. That's like, the way I liken this is, you use your credit card. If you use your credit card, that, yes, pardon me, you might increase your assets, but what you've done here with your credit card is you've increased the liability. That is, now you're going to have to pay that. So you're liable for that, for the money that was charged for that. And therefore, and to decrease, then that's a debit. And when all else fails, when you look at these, memorize them. And memorizing is not a bad thing. There's nothing, no shame in memorizing. And as a matter of fact, I think memorizing is a good thing and can help you quite a bit. So now you've got that on the slide, and we're going to go back to the slides in a minute as we progress through some examples. This material, again, for those of you who have been through accounting, this is Breeze City, perhaps. If this is new to you and this seems difficult and worth a struggle and struggling, let me give you just I don't know if this is a word of encouragement or a word of advice, but I think, and this has worked in the past, students I've worked with and tried to get through this. If you will give this a concentrated 1 hour's worth of study, and by concentrated, I mean, AirPods out and or your Beats headphones or whatever it is that you use, and door closed and television off. You guys don't watch TV. Distractions aside, comfortable chair, and take chapter 3 and just work through all those examples. And we're going to talk about a lot of them. Work through these examples and think about how this works. I believe sincerely that 1 hour focused study on this, and it will stay with you not only for now, but will be something that will be easily dredged up later, that you'll be able to make this, you'll be able to understand it. You'll be able to actually make it work. You could you could do a lot of this yourself on the job. But for some reason, the structure of this, people tend to not want to spend that focused time because they say, I don't understand it. Well, just give it a shot. I really do think that it's something that will the light bulb turns on. And I guess in this case, the light bulb doesn't, there's a lot of light bulbs and they don't all turn on at once. But once one turns on, it's easier to get the others to come on. Maybe it's like a fluorescent fixture, once one they all kind of struggling with the ballast, and all of a sudden one starts and one turns on and the others lighten up. That's a horrible analogy. Okay, let's get back to the slides, because you and I both want to make progress, because I have this strange hope that maybe we could actually finish early today. I have a service provider coming to my house. It's supposed to come today, and I'm hoping that they don't come during class. So there's our debits and credits slide with more stuff on there that might be helpful to you. And again, give it your try. If you can't think your way through this, memorize it. It's not that bad. You guys can do that. Okay, let's look at a just so you know, I had to close a window so I could see what I'm talking about here. And if I get distracted admitting more people to class, my apologies, but that may be coming. We'll see. Okay, let's look at this example and talk our way through it. And we're going to look at several examples and talk our way through it. Okay, so you order $10,000 in roofing materials. You're putting this roof up here. This looks like maybe a slate roof over here on the left, maybe a architectural shingles maybe on the right. Anyway, those obviously are different kinds of shingles. I'm confused. You order $10,000 for a project and you get an invoice. The practice of ordering the roofing materials is an administrative action, right? You or somebody, a purchasing agent at your company, orders this stuff, and that doesn't affect anything. It affects a lot of things, but it doesn't affect anything from a financial accounting standpoint yet. Receiving an invoice, there you go. Now, you would have had to have looked at the budget, made sure you're getting the right stuff and not overspending and things like that, given. But when you receive the invoice, all of a sudden, now we're into accounting. And so what do we do with it? And we're going to use the accrual method. Fortunately, that's the method that I'm most comfortable with. And here we go. What happens? Well, on the job, remember, we've got our job cost ledger, and here we go. We're job 110, and we're at phase 1, whatever that means, right? Phase 1. And here's our expense code right there, 06120, and it's M, materials. And so there's our job cost code, and that goes into the system, whatever the system happens to be, for $10,000, because that job has now spent $10,000 on roofing. Now, what happens to that? Well, we can look at the income statement and see that, we have expenses. And if you were to look back, and I should have been better prepared myself, and gone back to the general ledger and looked at the codes for the general ledger, and that's not the general ledger. Well, I forget it. Anyway, 610 materials. So we know that code is a, remember that's an income statement code, not a balance sheet code. I'm still trying to get there. There it is. Remember, all of the income statement codes start with 500 in our textbook. Start with 500, and that's revenue, and then it goes from there. So 610, there it is, materials. It's an expense, right? So that's an expense, and it shows up under materials, and it reduces our profit by $10,000. Remember, those parentheses mean it's a negative. And because, and since that would reduce our profit, see, those are going to zero out, right? Okay, now let's look at the balance sheet, which is where the beef, to me, of understanding how all this works lies. We received an invoice, so yes, it's an expense, and we already count it. We count it as an expense, even though we haven't paid it. But in the income statement, it's an expense because we're going to have to pay it, and that's just the way we do it. That's the way we account for it in the accrual process, is that it's already counted as an expense. And so the fact that we owe money, that's something we have to pay. That goes into the accounts payable. Whenever an invoice shows up, it increases the accounts payable. Okay, all you increase the accounts payable, and because everything has to, your assets have to equal liabilities, right? And we know that our assets haven't changed, our liabilities can't change, and logically, when accounts payable increase, then if we now owe that money, we know that the equity, the owner's equity, or current period net income, is, as it's labeled here, is the negative $10,000. And the current period net income, you can see, relates to the profit. You even got a little equal sign there, which is really a big equal sign, and that is that those are going to coincide. So when you decrease your profit, you're going to be decreasing current period net income. You can almost draw a little diagram here and make sure everything balances out and zeroes out. So when materials goes up, the profit goes down, and that profit going down feeds to the liabilities on the balance sheet and is balanced by the increase in the accounts payable for that invoice. Now, we haven't paid it yet. We'll talk about paying it here in just a little bit. But so far, no cash has changed hands. No money has flowed from point A to point B. It's an order and an invoice. And yet, all of this has to be reflected already now in the accounting system, in the balance sheet, under liabilities, and in the income statement as expenses, even before the first dollar has been spent. Okay, let's look at another example, and that is, okay, we hire a subcontractor, $10,000 of work, and we hold 10% we retain 10% until the work is complete. So how does that work? Well, once again, it's an expense. We go to the job cost ledger and we yank out the code So we've got, once again, job 110, and it's phase 1, and there's our charge code 22100 and S subcontract, right? And it's $10,000. That's an expense, just like that, just like the invoice, right? Just like the roofing material. This is an expense, and our profit our profit balances that out as a negative profit because this expense is happening. Again, the current period income, therefore, is going to be negative $10,000. That is a reduction of the owner's equity. And then, what about? So we have to balance that negative $10,000 with a positive $10,000 up in the liabilities section, and these are accounts payable. Again, this is going to be something that we're going to pay, so it's an account. It goes into the accounts payable account. And we also have code 311 here, accounts payable retention. So we know that, so we've split up the $10,000 into the $9,000 that we'll be paying, right? As we make payments to the subcontractor, we may make payments. And as we make a payment, the accounts payable will trade will decrease a little bit, right? Because we'll be paying that off. But the accounts payable retention will stay the same until we pay that retention at the end when the job is completed. And and that's coming. We'll talk about that in just a little bit. As a matter of fact, no, I'm not having you do that on your own. We'll talk about that. I hope these things are kind of making sense. The first few you might stumble around with, and it might be confusing. I get it. And again, you just have to be persistent. And I think if you're persistent, this will fall into place. Okay, so here we go. We're paying that roofing invoice, right? What happens when you pay the roofing invoice? Well, let's look at what happens here. We have, oh no, this is the roofing and the subcontractor. Sorry, we're paying these invoices. So what happens to the income statement? Nothing. And the job cost expenses? Nothing. Why is it nothing? It's because those things have already been accounted for. Remember, when they first appeared, even though cash never changed hands, they were already accounted for in our income statement. They were already counted as expenses on our income statement and our balance sheet expenses in terms of liabilities. Okay, because those were already handled that way, they don't affect at all the job cost accounts and the income statement. But we do, because now what's happening when we pay an invoice is we're now doing the accounting part of moving the money from one account to another account properly, to properly reflect, remember, the snapshot of the balance sheet to reflect the current situation. That is, we will no longer have these in accounts payable. They will now be paid, and it'll be reflected in a reduction in our cash. So our cash will now all of a sudden we'll have less cash than we had before, but our accounts payable will also be reduced accordingly. So here it is. We're paying $19,000, $9,000 to the subcontractor, and $10,000 to the roofing supplier. And so here we have this. Now, I want to make sure you understand in these slides what's depicted here. It's the activity that would go on in the books of account relative to this particular transaction or set of transactions. It is not the net end. So when I say right here, 310 accounts payable trade negative $19,000, that does not mean that our accounts payable are negative. No. It means that we're reducing whatever the accounts payable are. So we have a company that may have accounts payable $250,000. We're just going to reduce that by 19,000, and that reduction is what's signified here and presented here. Not the result after it's all done, but the one action in this particular step. So I hope that's reasonably clear. So in this step, we reduce the accounts payable by $19,000. Notice we haven't done the retention yet. So we're okay. We're not messing with retention yet. And that's negative $19,000. And in our cash account, when you pay things, when you actually pay them, you pay the invoice, you pay the subcontractor, it has to be cash, right? You don't pay credit with credit. They don't want credit. They don't want a promise. You've already given them the promise. Now they want the cash. So your cash decreases. Once again, this is like paying your credit card at the end of the month, right? You have your credit card and you charge things up. At the end of the month, you get the bill, and you have 30 days or 25 days or however many days you've agreed with your credit card company. I guess you don't agree, do you? They tell you how long it's going to be, and you have that many days to pay it. And during that time, you take your invoice, which is what your credit card statement is, and that's your account payable. You take that invoice and you pay them. They either deduct it directly from your bank account, or you write them a check, right? You don't use, now you can, I know there's ways that they have you moving stuff around from one card to the next. Don't ever do that. You're just gonna, that's a black hole of indebtedness. But typically they take the money out of your account, or you write them a check, and that's cash. That reduces your cash available. So that's exactly what's happening here. We reduce the accounts payable on the liability side, and therefore we have to balance that. Remember, assets equal liabilities. So our cash is decreased by $19,000. Now notice, this doesn't mess with the equity. You may be thinking, now wait, hold it just a minute. Why doesn't this reflect the equity? But remember, that's already been done. That was done when the expense was first recorded, way back when we agreed, when we ordered the roofing materials, or when we agreed with the subcontractor and we signed a contract and all that. So that was handled there. So the equity doesn't change at all. And our profit doesn't change, because once again, that was already reflected. Right here, we're just reducing the accounts payable and we're reducing our cash amount. So our assets still equal liabilities. And that's when we're paying the invoice. Now let's look a little bit about at labor and labor charged to a job. Gosh, I need to speed up. And you may want me to speed up, so let's speed up. Notice that you have, now, if you hear people talk about burdened labor, fully loaded labor, that means not only what you're paying the employee, but all the other stuff that comes with that. So you're paying them wages, and that's accounts payable to employee, and that's the wages that they would get paid. And it's possible that when you go to work, you get a salary, and you may also opt to say, oh, okay, I've got this salary and I want to participate in the company insurance plan, life insurance or health insurance. And so, and of course the government wants to participate in your employee by taking their cut from income taxes. So the company will take that money out before they write you the check, right? And they'll put that somewhere else. And the taxes and insurance part then are other elements. Taxes, you know, and taxes are income taxes, state and federal. And then there's FICA, what's called FICA, and Social Security and Medicare. Currently 7.657, some, I can't remember exactly, percent that they will take. They actually take take that from your check and they provide the same amount. It's another story. And then of course they have there's the insurance, and they've got vacation. And what you may not know is they accrue funds in an account to pay for your paid vacation, if it's paid vacation, and they're going to pay you during that time. Your pay during that time comes from an account, a vacation account, instead of course, you can't bill a job, right? You can't be billed to a job when you're on the Riviera. So, well, maybe some people can, but anyway, so let's see what happens here. You are paid labor. Here's job 112, phase 1. There's the code, and it's labor 1141.12, and that again, that's going in as an expense of 1141.12. It reduces the profit accordingly, right? And that's reflected in the equity on the liability side of the balance sheet. So that's going on. And when that happens, of course, this negative 1141.12 on your balance sheet liabilities has to be balanced. And so you've got all these accounts where we're going to accrue the payroll. That is, yes, we've counted it as an expense, but it hasn't been paid yet. That's great. This is just like an invoice to a person, kind of, right? Or from a person. A person does their work. They're kind of giving you an invoice. There's accrued payroll. This would be what is going to actually be paid to the employee. There's the taxes, and you may look at that and be shocked. No, that's pretty common tax level, 280.24, and that would go into the accrued taxes account. And you've got accrued insurance, so that's the insurance part of what the employee's receiving. And then there's the vacation account, and that gets built up as well. And as then we're going to spend out of here. We're going to write employees checks, and we're going to write the government checks for all of our employees, for all of the income taxes. We're going to write a check to handle that later, and the insurance will pay that later. These are just like invoices. And this actually happens in the systems, because you don't get, when a pay period is up, you don't get a check that day. Typically, you will get a check maybe 1 week hence or 2 weeks hence, and when those checks are written, then these accounts are addressed properly at that time. So that's labor that happens to be charged to a job. On the next slide here is labor that's just charged to overhead. You have accountants, and you have your company may have purchasers, and we haven't talked much about overhead. We won't get into detail on overhead, but this is not it's not charged to a particular job. It's just charged overhead. So it's a different code. Everything else is the same, right? Everything else is the same here. We've got but we've broken these things out and into the overhead accounts. And so these expenses go into the individual accounts here, and then bounce back up through the balance sheet in a very similar fashion. They're still accrued payable accounts, but it just charged. The details are charged to different accounts. And so back to the employee burdened, labor burdened includes all these benefits, right? The vacation and if they may pay part of your insurance for you, and they may they certainly pay half of the FICA. You pay half and they pay half. So those are what builds up what's called the burden aspect of labor costs. Paying the wages. So here you go. Once again, doesn't mess with the income statement. You take the accrued payroll. You're writing a check to your employee. Accrued payroll. You reduce that by the same amount of the cash that you pay your employees. So just like paying a bill, right? Just like paying for roofing materials from an accounting standpoint. Paying for payroll taxes, and payroll taxes are the FICA. That's the Social Security and Medicare. That the term that used for that is payroll taxes, and so there it is, right? There's your payroll tax payment, again treated just like the roofing materials, and same thing on paying the benefits. There's our accrued insurance, and so this can be for a whole bunch of people that you're paying this for. You wouldn't have to do this for each individual necessarily. For an insurance plan in the company, they're paying their insurance provider one lump sum for the whole schmear, right? Everybody. And so those are all piled into the accrued insurance account that you're now paying down. So that's how that works. Whoopsie, office rent. So you get, maybe you're renting some space. Now this doesn't go to a job, right? But once again, see what it does to the expenses. It's an expense. It reduces your profit, comes across to a reduction in equity and accounts payable. So it's an account you get, okay, we got to pay the rent. Here's the rent bill. We have 10 or 15 days or whatever to pay it. You may think, well, 10 or 15 days, can't you just go ahead and write the check and not worry about the accounts payable and all that stuff? No. Don't get fast and loose with your accounting and your finances. So that's how that works, just like paying a bill. So I'm hoping now that maybe up front, if you were confused, maybe you see that a lot of these are really very much the same. They're handled very much the same. Shoot, keep moving my mouse. Depreciation, again, we're going to talk about this next week. Works maybe a little bit differently. A depreciation is an expense. It's not a cash expense. But it's an expense. Reduces a profit. In this case, however, there are no liabilities to balance that reduction in profit, so we have to balance it on the asset side. So this is a little bit different than before. Depreciation is a little bit different animal, and we'll get into detail on Tuesday. So we have this negative 1800 that we need to balance out, and we do with by adding a $1,800 on our depreciation account on the assets. Now this is further confounding because depreciation is called a contra account, and a contra account means that we're on the asset side, but you subtract it, you don't add it from your assets. So as you depreciate property, this depreciation, accumulated depreciation increases, it's decreasing the value of your assets because of depreciation. The depreciation, accumulated depreciation account increases, but it's a contra account. So that's why as it larger it gets, the more you subtract from your asset value. And so the fact that it's negative here, so you've got a negative here, and it's negative because this is a contra account. So you're going to subtract from your assets. That may be too short a description for you. That's how depreciation is entered. A phone bill, if you get a phone bill, look at this. You get the phone bill, it's going to general overhead, but look, it's the same. It's just going into an accounts payable. And this is the way it's going to work with accounts payable. It's an expense, reduces profit, reduces equity, shows up in an accounts payable, and then we'll have to pay it at some point. And here we go. If you're billing for work. So we're billing for $100,000 worth of work, and you're assuming that they'll retain 10% of that until the end of the project. So once again, we're billing. There's no cash. We're just billing. And there's our job cost account. We have a revenue account there. Revenue is 100,000. It shows up on the revenue side, 100,000, and obviously our profits then. If our revenue's up, our profit's up. Revenue minus expense is profit. So we have our profit increased by $100,000 here. The profit increase of 100,000 shows up as an increase in equity of 100,000, as always. So that's how that comes across. And therefore, since there's no increase in liabilities, we need to balance the 100,000. Assets equal liabilities, remember? So our assets have to be 100,000. What is that all about? Well, this is revenue that's coming. We have billed, so we have accounts receivable, right? Now they will owe us $100,000. So $90,000 shows up in accounts receivable, and the retention shows up in accounts receivable retention. That's the 10% retention, and that's $10,000 out of the $100,000. Very similar process when money's coming in as when money's going out. Everything will look pretty much like that. Now, if we now bill, right, for that 10%, for the retention, we've already taken care of the revenue from that job and everything. Now we're just moving money. Nothing happens on the money side except we're billing them for the retention. Remember, they're not paying, we're billing them. So we just move, we reduce accounts receivable retention, and we increase accounts receivable trade. So we just move. That's not a retention receivable anymore. We've billed them for it. So now we're just waiting for them to pay it, and it's moved into the different accounts receivable column. Okay, we're needing a break, and we're going to do some in-class work here. So I'm going to flash up some questions. Now, I will be, full disclosure here, the answers to these are further in the slides. Maybe not in this directly following, but they're in the slides. I'd encourage you, during this break, if you don't actually solve these, think reasonably deeply about them without falling asleep. Think about them, and how would you handle those? How would you reflect those in just like this on this page right here? How would you reflect these 4 questions in the books? How are you going to do that? So I'm going to flash these up here during the break, and I wanted to give you 15 minutes, but 15 minutes is a long time considering how much time's left. So we're going to come back at 9:05, and let's make it 9:06. So it's 11 minutes, and 9:06, I'll come back and we'll go through these. Okay. So I'm going to leave this camera up with the questions on it, and we'll take a break, kind of rest, stretch, and work on these, and then we'll come back and talk about them at 9:06. And sorry for all the other background stuff. Hopefully you can see these, and we'll see you then. 9:06. All right, we're back. Um, let's see what we've accomplished. I'm hoping that at least a couple of these, if you tried them, and I hope you did, at least a couple of these were, they're very similar to what, or all of these are similar to what we've done before. Once you understand the pattern, how they work, let's dive into this so we can knock it out. Here's this first one. Receive a $90,000 payment from a client for work complete. So, again, and I'm beating this horse to death. I understand that I'm doing that. But again, when you receive payment, all that doesn't do anything to your it I mean, it feels like it does something to your income, right? But your income has already been reflected when you build that client. And we're not worrying about unpaid bills here. We're not getting into um, risk of billing and not getting paid. We're assuming that once you bill, you're getting paid, and losses are another issue, and they're handled a different way by accountants, and we're not doing those things. So you've already reflected that you've been paid essentially by these people on your income statement. All you're doing when you receive payment, is you're adjusting the accounts. You're crediting one and you're debiting another, right? You're moving money back and forth. And the debits and credits, now I haven't highlighted this, but if you look at what I started off with my little pathetic drawing, we could have used those debit and credit terms, and you would see how they would be reflected with increases and decreases in assets, liabilities, and whether they'd be revenues and expenses, whether they'd increase or decrease, things like that. But I went through it this way to try to maybe hopefully get you to think logically about how this is working without getting tied up in the terminology as little as possible. So anyway, you get paid $90,000. That was right, an account receivable, right? You had billed them, so that had already increased your accounts receivable by $90,000, and that's like that work that you billed $100,000 for, and so you get, you build them the 90,000, and your accounts receivable increased by 90,000, and the retention, right? Your receivable retention was 10,000, but we're doing the 90, and so your cash increases by $90,000 because they paid you, and in cash, so that obviously went up by $90,000, and your accounts receivable went down by 90,000 because you're not scheduled to receive that cash from them anymore because they paid you. So your accounts receivable decreased. That's offset, balanced by the cash increase on the asset side of the ledger. Remember, the income had already been counted, so the equity doesn't change, and since that doesn't change, and it's a when you get paid, it's a zero net change, right? I mean, it's already, all of that's already been reflected. So when you actually get the cash, it's a zero net change. Okay, that was the first question. How about that second question? Take out a loan, 110,000 to purchase a piece of equipment, and so we put down $10,000 for a $120,000 piece of equipment. We put $10,000 cash, so that's going to decrease our cash, obviously, and then we're going to owe $110,000. Once again, this isn't income or anything, right? We're not in it, and it's not an expense or a revenue at this point. We've got a loan, So it's really all balance sheet stuff. It's what we're paying, the cash we're paying, and our accounts payable that happens to be in long-term liabilities here because it's not something we're paying back within the year. We're not paying it back within 25 or 30 days, right? So that's not an accounts payable. That's a liability long term. So here we go. Our cash is decreased by $10,000, and our construction equipment on the asset side would increase by $120,000 because we now have, looky there, that's an impressive piece of equipment, $120,000 worth. So our net on the asset side is $110,000. That is balanced by the loan. Our long-term liabilities is increased. That's like a long-term accounts payable, right? By the amount of the loan, $110,000. So those balance there. Now, what we're going to do as we pay down that loan, as we pay it, our long-term liability will go down accordingly as our cash goes down accordingly as we pay on this particular loan. There's a couple of more slides here in between receiving an invoice. Let's go on down to the invoice. So this is slide 22 here. I'm going to go down to slide 25. This was the next one on the list. Receive an invoice for $500 to repair a broken elevator track. Well, okay, we do have an equipment expense on the job ledger, right? So this is, or on the equipment ledger, sorry. This is the piece of equipment, repairs and maintenance, $500. That's an expense, right? So we received the invoice, so we already count the expense. The $500, this should look familiar. This was some of the very first things we did when we started today. And this, our profits decreased by 500. That's reflected in the equity decrease. And our accounts payable went up by $500. So this is that typical kind of a balancing loop, if you will, reflection in the books of account. And the last one was sign a construction loan for $500,000. Where is that one? That's oh, that's way the heck down here. Well, you can see, there we go. And again, signing a loan is nothing, but let's reflect all that on the books. It's nothing to do with the income statement. So our this is a notes payable, our construction loan. It's not yet a liability. It's typically the construction loans are things that you can draw from, right? So we haven't drawn from yet anything yet. So this would have been a challenge for you probably. But there's an asset is due from construction loans, $500,000. So we could use all that $500,000, and this is going to be changed as we draw from the construction loan amount that we have, and we have an example of that we'll touch on next Tuesday. And our notes payable goes up, so we balance the balance sheet. We're out of time. I would encourage you to look through some of these slides that we haven't discussed today and see if they make sense. I hope that at this point, maybe there'll be a few twists and turns, but I think you'll be able to understand those. And for the most part, they're very repetitive of what we've done before. So this is mundane detail drudgery, but you need to understand kind of how it works. I hope you have a great weekend. You'll see a homework assignment pop up that'll help you to execute a lot of these things. There's a slide at the end of this set that talks about homework. Don't worry about that slide right now. I'm going to use some of that stuff, but don't sweat that at this point. I'll explain it in the homework posted on Canvas. Have a great weekend, and I'll see you next Tuesday.